Good afternoon and welcome back to Supply Chain Chat. I'm your host, John Barone, and this is the second episode of our biweekly series. Again, thank you to our producer, Janet Cohen at Market Vision, and a special thank you to our co-host, the National Restaurant Association Supply Chain Expert Exchange, and to Matt Rilleberger of Firehouse Subs, the current chairperson of that group. In the first two sessions, we wanted to get a quick jump on the two areas that have impacted restaurant costs the most during the pandemic. Last time we tackled meat closures and protein prices. This week we want to look at one of the craziest dairy markets of my career. I'd like to introduce Eric Meyer, president of HighGround Dairy. HighGround is a dairy advisory company and a dairy broker. Eric is a regular speaker at Market Vision events and usually spot on with his analysis. But I think given the unknowns in the current market, I'm going to have to give him a free pass today. So Eric, welcome.
Thank you very much, John. I appreciate being here and with you. And I wish we could have done it in person a couple months ago. And although I probably would have given some pretty terrible advice back then, given now what we know about what's happening with the pandemic.
Yeah. So to lead you in here, we started out the year with record high dairy products output, and then restaurants and schools shut down mid-March. Lead us through what happened and how it affected producers and product prices.
Sure. So prior to the pandemic, we were starting to see milk supply ramp up in a big way. For those that remember last year, which feels like an eternity ago, we had some very high cheese prices towards the back half of the year. And we carried those over into early 2020. And we were seeing there were some great profitability for dairy farmers around the country. And we were seeing some extreme growth, almost 3% year over year milk growth heading into the pandemic. And then of course, mid-March happens, everybody goes home. And the chain of events that kind of got kickstarted here has led us on an absolute wild ride in the dairy markets that have kind of shaken everyone to the core and have impacted dramatically every market participant, from the dairy producer all the way through to restaurant chains on our side of the end user side, and everyone in between. So to kind of get things kicked off here, there really were 5 core factors that kind of created this perfect storm of volatility. We were already at above average prices going into the pandemic. We hit some record lows, and now of course everyone is suffering, at least on the buy side, is suffering from all-time high prices on cheese. And all this happened within an 8-week window, going from all-time lows to all-time highs. So these 5, up on your screen here, we've got 5 kind of pillars or factors as to what happened. And so we had issues around supply. And so one of the things that we had that occur once restaurants and the entire food service supply chain, I mean, by and large, shut down. And while people went home, we saw in this country, it's kind of we're around 50% eat at home versus eating out. It's such a popular thing. And with all the different sectors of food service kind of moving to zero and everyone staying at home, we saw a massive milk dumping episode. Processors were seeing orders canceled. We had heard some horror stories about trucks showing up at cheese making facilities, only to have the buyers turn those back and say, we don't even have orders to fulfill these. And milk processors, cheese manufacturers, butter manufacturers sitting on finished goods that were made for a customer and now had no home. And so there were massive amounts of milk being dumped. Issues around credit, issues around where the next order was going to come from was a huge hiccup at the end of March and into early April. And so we saw some massive milk dumping. I've got a chart here in a couple of slides showing what that looked like now that we can look back at it. But around the country, farmers were being asked to dump the milk that they had made, millions and millions of dollars going down the drain with absolutely no home. As a result of that, we had supply restrictions put in place. So cooperatives and cheese manufacturers, butter manufacturers around the country had nowhere to go with this milk. And so there were two decisions that could be made here. One, which was widely accepted in the April to June timeframe, was to mandate or basically stop paying producers on a certain portion of their milk. That's unprecedented. We've just never seen any type of collective request by co-ops or milk handlers to ask their farmers, or basically tell them, hey, look, we're not going to pay you for the last 5, 10, 15% of milk you made on your whatever milk you made in March. Just pull back 5, 10% because we're going to pay you $10 a hundredweight, or we're not going to pay you at all on that final. So that was one option. And the second one was trying to move that product elsewhere. As prices collapsed in mid-April, the opportunity to export, or a very small window to export product, moved. And so West Coast manufacturers of dairy products found a small window to move export business overseas. We were more competitive than New Zealand, more competitive than Europe, and so Asia took us up on the deal. There were some very aggressive deals made, even above and beyond where the markets were at, just to move the product and allow milk to flow through those plants, just from a cash flow perspective. So in mid-April, we had, and I've got just a few slides. I'm pulling from some old presentations here. Land O'Lakes, Minnesota, select milk producers assessing farmers at a deduct of $9 to $10 a hundredweight for over-base milk or milk that exceeded 90% of March options. Ellsworth Creamery in Wisconsin said, we need you to reduce your milk supply by 7%. And even in letters that we were obtaining from some of our producer customers saying, we're going to give you a program just to get out of the business. We don't need your milk. We don't know when we're going to need it. We want you to exit the business, and we'll try and make that easy for you. And this is how dramatic things were. Idaho, Dairy Gold, Lactalis, DFA's Western region, Klondike Cheese, DFA, Southeast Milk, Grande Cheese. I mean, the list is kind of endless as to the number of cooperatives and milk handlers that in April just had no home for a percentage of this milk. And so they told farmers to pull back. And that's a hard thing. Farmers have, during economic times of growth or even recessions, farmers just make more milk. It's part of their, it's part of just the lifeblood of being a producer, is finding ways to make more milk. When the price is high, make more milk and make more money. When the price is low, try and make up for that shortfall with volume. It's just part of their nature. But given how dramatic things were, they pulled back in a pretty major way. And so now looking back on that, this is from the USDA showing in the federal milk marketing order. So this includes all orders now except for small pockets in Texas and then Idaho, which is an independent region. Milk dumping soared specifically in the month of April to nearly 350 million pounds of milk. So nearly 2%, which I know it doesn't sound like a lot, but that's a lot of milk to just disappear into a drain, or being spread onto a field, or being fed to fed to calves and not being produced. That's a big deal, losing 2% of your milk supply. What we did see, though, is that it recovered quickly, and it wasn't necessarily because of demand returning all that quick in the first half of May. It was more so that farmers actually did quickly pull back milk from and were able to accomplish that by reducing the amount of milkings. So many farmers in the U.S. milk their cows 3 times a day. They were able to cut back about 5 to 8% by cutting back to 2 times milking a day, and then making adjustments to feed rations to make that work. Then looking back at some of the other things that were happening. So as people were migrating back home and not going into work, schools closing down, the eat from home percentage shot up like a cannon. And so in mid-March, there was definitely that panic buying. We saw retail sales grow dramatically. They've maintained that strength. People are eating cereal again. For the last 30 plus years, year in and year out, fluid milk sales in this country go down. That's a given. It's just been consistent that we're losing 1 to 3% of our fluid milk consumption every year, except March to June of this year, where we've seen that number pop. Cereal consumption, which has been down sharply over the last number of years, that also spiked as people were eating from home. So retail demand has maintained its strength and an increase in market share over the last few months. The food service side, we've seen while the shutdowns and economies were down for 3 to 4 weeks, and because of that uncertainty, we saw the distribution network, and I'm sure you guys can probably speak to that at your individual chains better than I can, but supply chains were whittled down to almost nothing, making sure that food wasn't going to go bad, the uncertainty of a demand forecast. But as the weeks came through and certain markets opened quicker than others, and that the food service sector changed their ways and adapted to the situation with curbside, contactless, partnering with delivery. It's been impressive to see how creative the food service sector has been over the last few months to adapt to what we're dealing with right now. And so as that certainty kicked in, and as prices were rising, distributors, restaurant chains, anyone in that food service sector upped their orders in a fairly dramatic fashion in that May to June timeframe, ordering what we had heard also from having no orders to having 2 to 4 times the amount of weekly orders flowing into cheese plants. It overwhelmed the system in a place where we didn't have the milk because we asked producers to cut back that milk. We exported cheese and other products that were meant for the food service channel. And within just a matter of weeks, we saw the food service channel be reinvigorated, and having that pipeline get refilled over the last handful of weeks has put some stress on the system. And then
So
finally,
Eric,
go ahead,
just
John.
to cut in for a second, we a number of the other protein producers were talking about the difficulty in switching over from food service to retail and back again. I realize milk is milk, but with some of the dairy products, were there issues, downtime switching back and forth, or?
There definitely was. I think there's, and I think that was part of the problem, is that on the cheese and the butter side, we have lots of bulk butter in this country that's just stored for food service and other ingredient use. But we don't have a lot of what we call print butter or the retail butter. Same with cheese. Cheese in the food service sector is made in 5-pound, most of the time 5-pound bags, or if you're buying slices, those are in a much bigger package. That had been a fairly decent problem, and there's a lot of that kind of safety stock that people had. You started to see some of that show up in the retail channel for sales, but I think there were certain plants and certain converters that struggled making that switch. It wasn't impossible, but some places are set up and have a heavy food service side where they're set up to make 5-pound bags, and those places aren't able to make the 8-ounce shingle slice or the 8-ounce shred for the retail side. So I think that led to some of the difficulties within the supply chain of being able to adapt quickly to that situation. And then once you adapted to it, your food service customers wanted orders again. And so those challenges, I think, also led to kind of a clog up of the system from an overwhelming piece of the demand side between retail and food service.
So the food service product that was stuck in the pipeline in late March and April go away, get donated? go back to the
Donation.
manufacturer?
We saw some. I mean, if you go to our local grocery store, there's a 5-pound shred bag that would never have been in there before by a food service provider. I think that happened. You probably saw some big box stores or club stores pick up some of those as well, but much different packaging, much different rules. I think there was probably some, just forcing some things through the system that probably didn't play by the rules just to move some, but donations and some waste. I'm assuming there was a lot of waste in the system of things that were getting closer to expiration in the system that just ended up getting dumped.
So the entire pipeline pretty much got emptied out and then needed to be refilled.
Exactly. That's the when we were starting to hear of the two times, 3 times, 4 times all-time high, we know that retail demand is good. We know that food service demand has picked up again. But when restaurant chains are ordering 3 to 4 times the amount of product that they would order in an individual week, something was up, and it was about the pipeline getting refilled again and restocked, and trying to do that ahead of a rapidly rising market.
So the government got involved in a big way to support dairy farmers.
They sure did. And so the USDA, I should have made that box here, that lower box on the right, it just should have just enveloped the entire system, because in addition to the different things that I had spoken of, export business, instead of restricting supply, co-ops telling farmers to cut back, strong retail, and then a mid-May to mid-June surge in food service demand, the USDA pumped a whole lot of money into the system. So I'm going to skip through to, we'll go back to this block cheddar. It's a really nice timeline. I wanted to make sure I put a timeline of events as to what happened in the markets from prior to March, when we were trading around that. This is a block cheese chart from late February until today, seeing where things went and kind of the timeline of events that led this market down to 20-year lows to all-time highs in just a matter of weeks. But I wanted to talk about, I started building these slides just to add, what's the USDA committing things to, and it just continues to compound each other, because the USDA just continues adding more and more, or providing us with a little bit more transparency around a program that was just kind of cloaked in, we just didn't know what was going on. There's a lot that we still don't know about this program. But in mid-April, the government announced that they were going to come up with a program called the Farmers to Families Food Box Program. And so $3 billion was pledged to this program, equal parts dairy, meat, and produce. So $1 billion was allocated to dairy. And the goal here was to just, because of record low prices, that's exactly when we were at $1 cheese prices, these 20-year lows. The USDA said, look, we're gonna support farmers, and we're gonna support people in need by getting product right off the line and putting it right into to food banks around the country. And we're going to just move it quickly and feed people that are in need quick, and try and help support the producers to keep the product flowing. And so we got $1 billion, and the original messaging was this program was going to last through the remainder of the year, about a 10-month window, and that was approximately $100 million a month. So the industry kind of took that as, all right, that's a lot of money to spend. Even $100 million a month is a pretty good chunk of money that the government could commit to buying dairy products. And so when they announced that they were asking for bids, and basically saying, look, we don't care what you put in these boxes, whether it be fluid milk, cheese, butter, yogurt, UHT, or like long shelf life milk. You work with the local and regional food banks, find out what they need, and then build a box around it, submit a proposal. They gave everyone less than 2 weeks to build that program and build those bids. And then they gave themselves less than a week to work through those bids. And on that mid-April timeframe, they said, okay, for the first window of this program, which was a 6-week window from May 15th to June 30th, we're going to commit $317 million to dairy. And they broke it down, 133 million for this dairy box, 187 million for fluid milk, and then a combo box with all three, dairy, meat, and produce, for another 248 million. Huge, huge numbers. And what we found out, all they gave us is, here's the vendor, here's the type of box, whether it's produce or dairy or meat or fluid milk or combo box. Here's the vendor name, and here's how much we granted them. We had no idea what was in the boxes and how much volume was going to be pushed to it. But what we came to find out, and I've got some links here as to, you know, some of the details around it, and a lot of these vendors were small businesses or catering companies or even event marketing companies that submitted bids that had no licenses to distribute food and also didn't get the commitments for the physical product that they had promised. And so there was a mad dash to the dairy industry to accumulate volume and buy up volume or buy up future volume for a 6-week window at the exact same time that we're pumping through exports, that retail demand is good, that supply has been pulled back, and the food service supply chain is restocking itself. It led to chaos in the supply chain. We didn't have enough milk, didn't have enough cheese, and prices soared. And so we've had to deal with this from mid-May all the way up to now, where we had prices that went from, you know, look at lines 8 or time frame 8-9 in mid-April to $1, and we kind of hung around there for 2 weeks, just starting to see a recovery into early May. And then once we got to the food box winners, when we were around $1.40, $1.50 price, it didn't take long. I mean, just a couple of weeks for us to go from $1.50 to $2. And then throughout the course of June, we went from $2 up to an all-time high of 281, which the highest we've ever been was 245 on blocks, and that was during the bull market of 2014. And all of this happening in a matter of 8 weeks from low to high. It was just unprecedented situation. And so we're still dealing with, so now we've got round 1 of this Farmers to Families food box program is over. 2 weeks ago, they announced that they were extending some of the contracts in round 2. Just last night, nice of them, they announced that the round 2 is going to be $288 million of spend, which is over the course of a 2-month window, July and August. That does represent less than what was committed in the first 6 weeks, about 32% less in total dollars. But the one caveat here is that the commitments to all 4 rounds of this program through the November-December timeframe, should the USDA want to renew those contracts, those bids and the prices had to be in by May 1st. And so in May 1st, the highest price on the futures board for cheese was $1.67. Today's spot market price is in the upper 260s. So these companies have had to continue to scramble to find physical product, and they're paying way more than what they committed to through the USDA. We're hearing from vendors that are our customers that have these contracts is that they're not able to renegotiate the price of what they've committed to, but they can make some changes to the spec. So you can ship a little bit less cheese. You can change what type of cheese or what type of dairy products. We've seen some people move from natural shreds into a processed cheese, or, you know, a Velveeta style cheese to put in there. We've heard of some vendors making adjustments completely, moving to ricotta over shredded cheese, or a brick of natural cheddar that's been incredibly hard to find. So they're trying to make adjustments here, but the government continues to throw money at this problem through a food box. In addition, there are other buckets of money that are part of not only dairy product purchases, but also direct aid to the farmer to help them recover from the milk dumping from March and April. So Section 32 is just another bucket of money that was allocated $120 million in dairy product spend from August 16th to November 15th, which includes almost 38 million pounds of cheese, almost 11.5 million pounds of butter, and 44 million pounds of fluid milk. much less than what's being committed in the food box, but at least we know exactly what they're buying. That alone is about, we're estimating about 1.25% of the cheese that's being made each month is being committed to this Section 32 program. In addition, while smaller, there's still money left over in a bucket for the China trade mitigation, normal USDA buying for food banks that has money in the budget. And then through the CARES Act, as one of the relief, there was a coronavirus relief. Most of that money was in the June timeframe, but they still have more funds that they can push out as well. So in addition to the $600 million of the billion that's already been spent in the first 3 months of this program, 3.5 months of the program, we also have these programs that are pulling from cheese and butter and fluid milk, as well as, and I know there's a lot of words here, but in addition, farmers are getting direct payments. So through yet another bucket of money through a Recovery Act, farmers are getting, what's the number? It's $6.18 a hundredweight. So we've narrowed it down that the max payout for producers will be somewhere in the neighborhood of a farm that makes that has 1,500 to 1,800 cows. They're maxing out a payment of $125,000 per commodity, but also per partner, up to 3 partners. So I'm sorry, that was the original guidance. They actually doubled that number. So large farmers can receive up to $750,000 per farm, so long as there are 3 partners. And nearly every dairy farm has a husband, wife, or a brother, sister, brother, family members that are a part of it. So payments can be less than that, but they will likely be made, that payment likely makes them whole versus the dumped milk that they had in the March-April timeframe. The price of cheese has gone from $1 to $2.60, where are we at here? $2.67 cents a pound. The milk price traded, the June milk price traded as low as $10.68 a hundredweight, which is pretty devastating. That's well below the cost of production, more than doubling over an 8-week period, where July milk now, it settled just below $23 a hundredweight. So a more than doubling of their milk price in just the number of weeks. When I ask farmers what they're going to do with their direct payments, especially those that use the markets to hedge, they told us that they're going to either buy more cows or buy a beach house. It's a really strange time right now to be a dairy producer. They've been given a ton of money, just helicopter money that has been put into their accounts, most of them by the end of this or last month or in July. And they've been given, their milk checks are going to start to go up dramatically here over the course of time. So just a tremendous amount of farm aid. There's still money in the budget to continue that through August. I'm not going to speak about politics, but this administration has been really good about giving producers money when they cause trouble. Obviously, a pandemic was no one's fault here, but they are good at supporting dairy farmers, and it just wouldn't surprise us if they continue to renew this aid up through the election. It'll be less than what has been front-loaded into the program, but certainly just a lot of money flowing into this sector.
So, Eric, obviously COVID is affecting the dairy products mix. You mentioned that there's more milk being bought at retail. How's that affecting cheese and butter? Is that pulling production, reducing production there? Will it stay that way? Will it normalize? Where are we going?
So it is, right? So I think the one hidden secret here that's kept prices and that caused such a rapid increase is that, like, as I had said earlier, every year over the course of the past generation, we've had less fluid milk consumption. And that means, and we've increased our milk production over time throughout, every year we're growing 1.5% to 2% a year by and large. That's left a tremendous amount of milk to be pushed into the manufacturing channel. But with this sudden reversal where fluid milk consumption has gone up so much that it's taken milk away from the manufacturing channel. So the government's asking for fluid milk. consumers are asking for it at the retail store, and the government's also asking for a lot more cheese and butter. And as such, it's such a big drain. Is class 1 milk or fluid milk in the class pricing system in the U.S., it will always provide the fluid milk channel with the first crack at it. It provides the highest level of money back to the farmer. It'll always grab that milk, and it's mandated that, like in certain specific regions, if the fluid milk sector needs the milk, the class 3 plants, the cheese plants, don't get it. And so that's created a scramble. Long term, has there been a rapid shift back into fluid milk consumption and people's habits are going to change? I don't know. I would imagine that we may be in this new world for a while, and I don't even know what we call it. You know, the psychology and sociology of eating from home, eating out. But it certainly felt like as markets opened. I know here in Illinois, as we were one of the last areas to kind of open our restaurants, even for outdoor seating, there's definitely some pent up demand for wanting to get out of the house and make that change. I think we've had some. I think retailers have done extremely well during this time frame. Except now, as the months, we went from $1.67 monthly average in May to over $2.50. This is for block cheese in June. That's going to create a situation for everyone on the buy side, both retail and food service, to potentially deal with some mitigation factors. Is that these prices are untenable. Either less usage on a pizza, migrating away from any kind of specials that include dairy products. That'll probably erode some demand over time. It's hard to say what if people are going to start eating cereal again because they've re-experienced it. Once we go back to normal, which may take some time, we may be in this mess for another year. As scary as that might be, the second wave is looming. The last few days we've seen record COVID cases in certain areas, and so while in Illinois we're enjoying low numbers right now, the rest of the leaders that have opened up markets are starting to see some issues, and state governments are making some changes and rolling back some of the eased restrictions. Maybe we are going to be in an environment where the fluid milk supply will, or the fluid milk demand will stay strong for some time. It's hard to say. I think that's a real difficult thing. We're still trying to fully understand the changes in food consumption here. We just haven't had a big enough sample to understand if this is something that's going to be sustainable or not.
Well, I know that for me, ice cream's the second best thing to alcohol in fighting the COVID blues. I've seen nothing but lines outside of ice cream stores. So that's got to be pulling some cream away from butter too, I would imagine.
As has making more full fat cheeses as well, because of the tight milk supply. People are not leveraging, they're using all the milk in cheese production, and that's keeping the cream in the system. So when there's an excess of milk in the system, you're able to, particularly for part skim cheeses, you can sell off the cream to a butter manufacturer or to an ice cream manufacturer that'll take that off your hands. When milk is tight, and the non-fat dry milk market, so the skim solids market is not weak, but at a much cheaper price than class 3 milk. You keep all of the milk in the cheese vat and you add non-fat dry milk or some sort of skim protein into the milk to make like a mozzarella or a part skim cheese. So the cream is staying in the cheese channel and not flowing into butter. We've been lucky up until this point. There's a lot of butter in inventory, and it's allowed the price of butter and non-fat dry milk, there's also a lot of inventory of that as well, from getting out of control. In fact, we've had a record spread between class 3 milk prices and class 4 milk prices, over $8. We've never seen that happen before, where the spread between the cheese and whey stream of milk, profit stream for milk, has exceeded in that type of fashion the butter and non-fat dry milk channel. That can't last. If the cheese price remains this high, more milk will flow into cheese production, and we'll whittle down those stocks pretty quickly. So if this is an issue right now, because of the large bulk stock of butter in this country, and the fact that we're really not going to be able to cut any additional export deals outside of what was cut during the low prices. We got down to $1.10 in mid-April. You know, if the price of cheese stays high, the class 4 channel, both non-fat dry milk as well as butter, will have to come up.
Okay, you got, what do we got left slide-wise?
So I've got one additional slide. So what I wanted to make sure that, and before any other questions that you or anyone else might have here, what I wanted to show is just the dramatic change of the forward curve on futures from where we were. I was able to pull one from April 28th. So that was above the lows. We got as low as $1 on both block and barrel cheddar cheese. So processed cheese buyers as well as natural cheese buyers saw $1 markets, and just people dumping cheese onto the exchange. It looked like it was going to stay down there for a long time. Recessions, when we look back at, we were making 2 to 3% more milk. We're dumping milk. We have no demand. It looked like we were moving into a recession, which we're in. But during the last recession we had, we saw a fairly dramatic decrease in dairy demand on top of what we had before were high prices. And so the forward curve, and this is the graphic on top from April 28th, when we were at historically low cheese prices, which was just 2 months ago, the forward curve priced in a very steep premium. We were well above $1.60 for the July to December timeframe. And when you're looking at $1 or $1.25 or $1.27, and you've got people dumping milk and no demand available, it just, when you look at a chart like this, and for the last handful of years, this is the chart that we put up at Market Vision, is a low spot price and much higher deferred futures. For the past number of years, outside of just the fourth quarter of last year, you've had to pay up to get your fixed pricing done. And that's typical in a bear market. It's also a difficult decision to make, because in bear markets, which tend to last a while, especially when milk is flowing and demand is okay or not that great, is you're going to have to pay up quite a bit. And when the market is at historic lows, it's a very steep premium you've got to pay. That's a hard decision to make. Fast forward 2 months from now, where the price of cheese is approaching $2.70 and barrels are over $1.40, we have a completely different view of the forward curve in the second half of the year, where we now have a steep discount. So hindsight's always 2020, where had we known what we know now, buying $1.60 cheese and $1.50 cheese in June, and $1.60 for the second half of the year would have looked like an incredibly, would have been a very smart decision. It was hard to do at the time because of the fundamentals suggesting that we were entering into what could have been a very nasty phase of bearishness. Now we've got an inverted curve where the decision to lock in cheese prices in a vacuum, there are still many challenges, particularly for restaurant chains, to understand what your demand outlook is like. And I totally understand that it is a challenge to predict what volume you can lock in the future. But when looking at $2.70 block cheese, and you look at August futures at call it $2.23, September futures that just pierced over $2, and then the fourth quarter of the year, looking out at December is just barely over $1.70 right now. There is an extremely steep discount for the market here that can be locked in. And so there's so much uncertainty in the market, but what this inverted curve provides you is an opportunity to not pay $2.70 should we stay up here for an extended period of time. I can certainly go. I see a question coming in about looking at the butter outlook for the next year, and I can give a few minutes on what to look for from a cheese outlook. But this is probably the most uncertain time that we have ever had in our markets, where the uncertainty around supply and supply recovery, now that farmers have been granted kind of now they can make as much milk as they want, It's a hot summer, and turning cows back on is not the easiest thing to do. And having an inverted curve while in a recession. None of this makes a whole lot of sense when you kind of peel back the layers of onion and look at the macro. Cheese prices shouldn't be this high, but because of decisions that had to be made and because of the unprecedented disruptions in demand, which led to these disruptions in supply, we're now where we are. It shouldn't surprise me if the market stays up here because of the impressive government bid in cheese. And on the flip side, it wouldn't surprise me that with potential second wave COVID shutdowns, that we enter into a longer term recession where demand for dairy products without government aid rolls us back. And that as quickly as we went up, we could certainly make a substantial correction here. And the prices that you lock in may look foolish as what the forward curve we thought would have been a not so great idea in mid to late April now looks like a great idea. Does locking in prices in early July for the remainder of this year look like a good idea? Yes, it looks like a great idea versus where we are today. But where we are next week and 30 days and 60 days from now, the fundamentals are so messed up right now that it's very difficult to judge. And so I think we have to, as buyers and looking at the procurement side of this world, we have to look at what's certain and what isn't. And what's certain right now is you can pay a lot less by locking in futures markets in the coming months than you're paying today. Is it worthwhile to do that? I would say on a percentage of your cheese buy that you feel confident that you're going to have from a demand perspective, it might not be a bad idea to get some protection around this inverted curve.
So Eric, I would imagine that there are companies out there that are hedging into this forward curve. What are the big cheese companies or the big food service players like a Pizza Hut and a Domino's? I mean, how are they playing this? Do you have any insight on that?
The largest hedgers are consistent hedgers. So your largest companies are always in the market doing something. And so is their timing always right? Well, no, but they're always in the market doing something. And so but during this pandemic timeframe, I would say, looking at open interest, is that like last year, where we didn't see a whole lot of hedging, this year in particular, we're also seeing not a lot of hedging. And we're gauging that by the amount of total open positions in the futures market and what we can glean from kind of the swap markets that aren't on the exchange, is there haven't been a lot of end users contracting out through the remainder of this year. So does that present an opportunity to do something? Yes. Am I confident that the curve is going to look like this in a month or two? I don't. I think it could quickly, I think this market could definitely flatten and go the other way. But if the government keeps buying and throwing this much money at this problem, and people don't pull back on the commercial side of the demand sector, we could remain at elevated levels, not necessarily at 270, but we could remain at elevated levels above $2 for quite some time. But if the government stops buying in August, the party could end quickly and things could revert fast. So I wouldn't be, and I know that the largest players never hedge 100% of their product, or at least if they do, they don't pick a number. They create more of a collar strategy around it, a min-max type strategy around something. But the forward curve provides certainty, and that certainty, and people, even with a steep forward curve, they have the foresight to just say, look, $1.60, even $1.70, those beat my budget for the upcoming year, and they provide me with certainty. And so they tend to be consistent hedgers throughout, whether the curve looks good or whether the curve looks bad, they stay in it. And that takes out the volatility that we're seeing today. So
25%?
Yeah, 25, a third, even up to 50%. I think it depends on, you've got to take a decision as to if the price of cheese remains above $2.50 for 3 months, 6 months, how devastating would that be to your business? And if it is, then you better get some coverage now because you're getting that opportunity to do it. You may be wrong. I think in extreme bull markets, which I'm not sure if we're in a bull market or not, I just know that we're in the midst of trading a pandemic, which no one's ever dealt with before. So our uncertainty radar is just like popping through the roof. But locking in something creates, or protecting a price, locking in an upside and maybe sacrificing a downside, kind of creating that collar type structure. This gives you, you're getting that opportunity to do it right now. That if somehow they want to push this market to $3 and things stay tight, and it's super hot for the next, and it is hot in the upper Midwest right now, it stays hot for the next 2 months, that could create a supply gap that even $23 milk, closing in on all-time highs on a milk price, can't solve overnight. And so the market's giving you an opportunity to lock in a discount. If you can't sustain at these types of prices and your cost and take mitigation factors around it, then the financial markets are giving you a window to do something.
So to move to Q&A, I see that you're being asked the same question. You get asked twice a year from Jimmy wants to know what to do with his ice cream contract for Cold Stone. So
yes.
Hope you're feeling at home with that one, because I know you get that one regularly.
I do. So butter's a really interesting one, as we went from $1.10 low to, we did trade over $2 on butter during the rapid upswing, but because of the extreme amount of butter in inventory, the price has not gotten out of control. And in fact, we've rolled back about 25 cents from the recent high from a handful of weeks ago. And so the market actually is in a carry structure where you're in the, looking out into the deferred contracts. You could pay $1.76 for butter today on the exchange, but in order to lock in a longer term contract, you're looking at locking in something in the low 190s right now. As I'd said before, the butter outlook is interesting. Cream multiples have remained very tight. The class 3 channel is holding on to its cream. And if we struggle with the milk supply recovery here, which economics are telling farmers to make as much milk as possible, the summer may preclude that, and it may take until Q4 for us to start and the weather to cool down a bit, and a few good milk checks underneath farmers, and to get all their stimulus for them to kind of make a rapid turnaround. They held on to the vast majority of their cows. It was all about adjusting the ration and adjusting their milk, that we'll see that milk production recovery. But our cheese, we've got a long time butter trader and have been a part of the class 4 milk complex, and he's concerned that the increase in retail demand that may hold through the end of this year, some export deals that were cut that may dramatically slow butter production throughout the summer, may be a very strong draw on stocks. And given the discount in class 4 milk versus class 3, if cheese prices stay high, butter has the ability to make some gains. And so the curve in the market is not super dramatic. Dollar mid to upper 170s versus a low 190s coverage. We're advising at least through the peak season here. And if we're all stuck at home during flu season again, people are going to be buying retail butter at the stores. That it's not a bad, these are not horrific places and prices to get coverage. Again, a huge caveat that this market could change rapidly and fundamentals are different. But given that in June, there was an $8 per hundredweight discount between the extremely high class 3 cheese and whey stream versus the butter powder stream that was still well below average, butter and non-fat dry milk may make up for it quite rapidly. And if we're holding on to the cream in the cheese complex, and that fluid milk demand also remains strong, butter could see a pop here. So I guess I'm bullish if the stars align, and then if we all go back home and food service demand collapses, which is a pretty decent pull on the fat side, and the government stops buying butter and stops buying fluid milk, we could be in a different place. But I think I'd rather have the protection on at a level that, sub $2 butter. I know that, years ago, that used to be a high price. But given the fact that we spent 6 years above $2 and the fact that we've been below it here, you know, what's $1.92 versus, you know, $2.50 amongst friends of what you endured from 2013 to last year.
All right. Well, it looks like our Q&A is pretty light here, Eric, and we're pretty much out of time. So if you have any closing comments, I'm gonna cut it off there.
Absolutely. So again, there's this time during the pandemic, as a 20-year student of the dairy markets, I feel like I've woken up for the last, you know, the April, kind of as we all started to go and work from home in mid-March, all the way through about a couple of weeks ago, where we've officially thrown our hands up at the amount of stimulus that the government has injected into the dairy markets. Is when the Fed gets involved, don't fight it, and stay, you know, and you just have to embrace what's happening now. It's not pretty. I know for restaurant chains, this is just an extremely challenging time. Your costs on dairy are not helping the situation of trying to muddle through things. I would say, you know, just really hard to be an analyst in a market like this. I mean, we can certainly, I think the best thing that we can do is to provide you with timely intelligence of when things are happening. I think that's what our subscribers have appreciated most, is when things are happening quickly, we're at least relaying that information. It's difficult to predict off of fundamentals when they're changing so rapidly and you don't have good transparency into what the government's injecting in. So we feel you, and you know, it's been such an incredibly challenging time for us to try and get it right for you when it comes to trying to predict where dairy markets are going to go. We're at record highs today. Things could change quickly, and so I think it's just important as supply chain professionals is to just stay in the know and make sure you're aware of what's happening, because the price could change here dramatically very quickly. Biggest volatility I've ever had in the last 20 years. And I don't think we're anywhere close from being out of this just yet.
Okay. All right. That's going to do it for today. Thank you to Eric, and thank you to everyone who tuned in. I'm going to be back in 2 weeks on Thursday, July 16th, and I will be solo. I'm going to give a brief economic outlook and also talk about every controversial subject you can think of, from COVID to politics to the racial situation in the US, and my usual conference rants. So I wish everyone a happy 4th of July weekend. I didn't realize until Tuesday that tomorrow was actually a national holiday. I always think it's going to be on the Monday. But thanks everyone for tuning in. Thank you, Eric. Hope to see you in 2 weeks, and have a great weekend. Bye-bye.
Thank you.